Welcome to The Explainer, where we decode the stories hidden in the data. And today, we're digging into something big. A massive, sophisticated trade just hit the market, placed by a financial whale. We're going to follow the money to figure out exactly what they're up to, and more importantly, why. Okay, let's dive right in. An anonymous trader, what we call a whale, just placed this enormous bet on a medical tech company called Edwards Lifesciences. We're talking about something like 5,200 options contracts. Yeah, this isn't a whisper, this is a shout.
So the big questions are, who's making this bet, and why right now? Because let me tell you, this is not your average, I think the stock's going to go up kind of play. Now, this is way more complex, it's surgically precise. So we're going to break this thing down, piece by piece, to see if we can figure out what this whale might know that the rest of us don't.
Okay, first things first. How is this whale actually placing the bet? They're not just buying stock, that's for sure. They're using a really sophisticated structure, something called a risk reversal. This is classic smart money stuff.
So what in the world is a risk reversal? Think of it like this. It's a super clever way to make a big bet that a stock's going to go up, but without paying a lot for it. You're basically saying, I think it's going to rise, and I'm betting it won't fall below a certain point. And the magic is, if you structure it right, one part of that trade pretty much pays for the other. It's just incredibly efficient.
All right, so how did they pull this off? How do you make a massive bullish bet for next to nothing? Well, this is where the real genius comes in. The whale is basically exploiting a little quirk in how the market thinks, or more accurately, how it fears.
Okay, so here's the anatomy of the trade. You've got two sides to it. On offense, they're buying 2,600 calls. That's the bet that the stock is going to soar past $92.50. But to pay for that offense, they play defense. They're selling 2,600 puts, which is basically a promise that they don't think the stock will ever drop below $82.50.
And that's the million-dollar question, right? Why on earth would you agree to buy a stock if it falls? I mean, that sounds super risky. But the answer? Well, the answer shows us this incredible little crack in the market that this whale is just driving a truck through.
And that crack is called volatility skew. It sounds complicated, but the idea is simple. The market is way more scared of a big, sudden crash than it is excited about a slow, steady climb. It's just human nature, right? And because of that fear, the insurance against a crash, those put options, is way, way more expensive than the lottery tickets for a rally, the call options.
And this quote just nails the whale's entire mindset. They're looking at all this market fear and basically saying, you know what? I'll be your insurance company. You're all so scared, you're overpaying for protection, fine. Sell me that expensive fear, and in return, the money you give me is going to pay for my bet that this thing is going to the moon. It's just a brilliant trade on psychology.
And look at the result. Just look at this. A normal bet, just buying the call option, might cost $4 a share. But by using this strategy, by selling that fear, the whale got their entire bullish position for just 40 cents. 40 cents. That is a 90% discount. It just blows up their potential return on investment. Okay, but a trade like this is only smart if you're really sure the stock isn't going to crash, right? So what makes this whale so confident? Why are they willing to draw that line in the sand at $82.50? Well, first off, that price, $82.50, it's not just a random number they pulled out of a hat. It's anchored right near a huge technical level, the 200-day moving average. You can think of this as a big, invisible tripwire for all the major trading algorithms out there. When a stock gets close to it, these programs are often set to just automatically start buying, creating this really powerful floor of support. But it's not just a technical floor. There's a fundamental one too, and this might be what the market is missing. Edwards Lifesciences isn't just some sleepy, stable company. They have this new unit, the Transcatheter Mitral and Tricuspid Therapies, or TMTT. And get this, it is growing at a staggering 57% year over year. That's like having a high-growth startup tucked inside a blue-chip company.
And the whale? They're not the only ones who see this. They're not alone. If you dig into the filings, other big smart money players are piling in too. JP Morgan just scooped up another 7 million shares. And to top it all off, the company itself is buying back its own stock, $500 million worth. So you've got the quants, the big funds, and the company all saying the same thing. This price is a bargain.
Okay, so we've got the what and the how. But what about the why now? The timing of this bet, that's maybe the biggest clue of all. The expiration date, March 2026. That is so specific. It's like they've cast a net, and it's set to close at the perfect moment, to catch a few very specific, very big fish. And this calendar just lays it all out for us. First up in January, you've got the J.P. Morgan Healthcare Conference, the biggest one of the year. Then, in early February, their Q4 earnings report, which everyone expects to be really strong. And then, the main event, the crown jewel. Sometime in that first quarter, they're expecting FDA approval for their new Sapien M3 system. We're talking about a product that could open up a market worth billions. Billions! The whale's bet is set up to cash in if any one of these things hits.
So, let's pull it all together. What's the final verdict here? When you look at the whole picture, the clever structure, that rock-solid defense, the perfect timing, what does this trade really tell us?
It tells us this is what the pros call an asymmetric opportunity. It's a beautiful thing. The defense, selling those puts, is super high probability. You've got the algorithms, the institutions, the buybacks, all creating a floor. The offense, buying those calls, has what they call high convexity. That just means the upside is basically unlimited. For every dollar the stock goes up, their profits accelerate. It's a tiny key that could unlock a massive treasure chest. And they got the whole thing for pennies on the dollar, all paid for by market fear.
So, by decoding this trade, the whale has pretty much shown us their entire hand. They've put their cards on the table. The signal is crystal clear. They believe this stock is going to defend 82 bucks and make a run at $100, all in the first quarter of 2026. All the evidence is there, and it leaves us with just one final question. Are they going to be right?